Welcome to Jeff's World, the weekly 30-minute show where our goal is to help you make more informed investment decisions. We're going to cover key opportunities and risks for investors tied to developments around the world, very focused on tariffs today. And we're going to take your live questions from the chat on YouTube so you can ask us what's on your mind at any time by just entering it in the chat. And we'll get to those questions in just a few minutes. Heather's keeping a close eye on them. First, I'm going to share some of our latest insights. Now, we've got a few required disclosures, of course, before we get started. We don't know you personally, so we don't make personalized recommendations, but we talk generally about the markets and the sectors and the areas of investing we think are likely to perform well, poorly, and why. Of course, things can and do change, so while our thoughts are subject to change as well, could change very rapidly today and this week and this month. And of course, investing has risks, and international investing has unique risks like currency moves, so please keep all that in mind. Now, Michelle is on vacation today, lucky her, but as is the case every week, Heather O'Leary on the global strategy team here at Charles Schwab is with me this morning. Good morning, Heather.
Good morning, Jeff. As always, I'll be watching the chat and the questions closely, and we will get to those shortly. Can you go ahead and kick us off, Jeff, with a quick rundown of what we're watching this week that can move the markets?
Yeah, Heather, I know you've got a little bit of a cold or flu there, so thanks for hanging in this morning. Look, the biggest issue this week, no doubt, is the overhang of President Trump's baseline tariff of 10% on U.S. imports from all countries that took effect on Saturday, with the much higher rates to be applied to many countries on Wednesday, and then retaliatory tariffs from China on all U.S. exports to China kicking in on Thursday. Now, today, we already saw a wild swing in stocks on a rumor that Trump was considering a 90-day pause in tariffs, excluding China, based on a Fox interview with National Economic Council Director Hassett. I watched the video. Hassett did not actually say a pause was imminent. He was asked if Trump would consider one, and he kind of said yes at the beginning of his answer, but it was more of a deflection, and he really more focused on the fact that there were a lot of great offers coming in from other countries, and that the president would decide what the president decides. So no pause imminent, but the National Economic Council Director did note a lot of countries making really great, quote, great offers to the president in order to avert those tariffs. So a lot of volatility. Clearly, the market is hinging off of any developments here, that a deal might be forthcoming or a pause. We saw a swing of about 8 percentage points in about 30 minutes in the S&P 500 there. So pretty amazing. Get used to that volatility, I'm afraid. On Monday, today, EU trade ministers are meeting in Luxembourg to jointly discuss how to react to President Trump's tariff package. They haven't announced a response just yet. Markets obviously be closely watching to see if they're offering a deal or any kind of retaliation, or maybe a little bit of both, right? A little bit carrot and stick. We'll see what they come up with here perhaps later this week. On Wednesday, we're going to get the Fed minutes from the March 19th policy meeting when they held rates steady. But the markets might not read too much into the details, since much has changed in the last 2 weeks with rising odds of a recession. I know there was a closed-door meeting at the Fed today, maybe possibly thinking about emergency rate cuts. I think that's one of the reasons why futures began to rebound before the open. The idea that the Fed was going to gather and might even cut rates today, I don't think that's immediately likely, but that is something that appeared to be under consideration. It's one of the things that lends some strength to the markets. We're going to get some more insights on that over the course of the week. And then on Thursday, we get the CPI. The U.S. March CPI inflation comes out against this backdrop of tariffs and elevated costs of living. Early estimates point to a slight month-over-month increase in inflation, and year-over-year inflation actually slowing down to 2.6%. Still much above the Fed's target of 2, but coming down from 2.8 to 2.6. The report, though, may just establish the basis from which future tariff-impacted price changes are measured from. Yeah, tariffs can raise inflation, but a recession can also lower it. So we're sort of a battle between the two as we get this question of higher prices versus lower demand pulling prices down. So again, this might be the report upon which we kind of measure the impact of those tariffs going forward, kind of the baseline for what inflation is pre-tariff. But it isn't all policy news. On Friday, we're going to start the earnings season. Yeah, almost missing it in the context of everything going on from a macro perspective. But we're going to get major banks. They always lead the charge. We've got JP Morgan Chase, Bank of New York Mellon, Morgan Stanley, and Wells Fargo on Friday, giving us a sense of what the credit situation looks like. Rising bankruptcies a factor. What are we seeing on loans and demand for credit? All those other factors be very interesting to see, not only in terms of the results of those particular businesses, but what it means for the overall economy. Finance being very important to all of that. But today, of course, I want to focus on how to invest during a trade war. But let me get us up to speed on what's happening and what may come this week on tariffs. So following 3 days of gains, Monday, Tuesday, Wednesday, the stock market fell on Thursday after the new U.S. import tariffs were announced on April 2nd. The 20% tariffs on the European Union and 10% on the UK were largely in line with consensus expectations, kind of what we've been warned to expect. But the announcement for other countries, particularly in Asia, came in very high relative to expectations. China combined 54% tariffs, Cambodia 49, Vietnam 46, Thailand 36, Taiwan 32. That was a negative surprise to global markets. We calculate that the new tariffs bring the overall average rate of U.S. import tariffs to around 25% when they're implemented this week. That's a huge surge in U.S. tariffs. You can see what the Trump 1.0 tariffs look like there, a little bit of an uptick. This is absolutely massive. So while we can say, tariffs have been applied selectively to certain industries over many, many years, they in generally are within one industry, one or a handful of industries, and they're fairly low overall. This is a very big game changer. And it's not just the tariffs, but also the impact on growth from business leaders pulling back on investment and consumers becoming more cautious. That's weighing on the stock markets. The drop in oil prices, as well as the decline in the dollar and bond yields, show that investors are considering the possibility of a broader economic slowdown, maybe even a recession, particularly here in the U.S., instead of just shifting trade patterns. More tariffs are likely to come this week. I mean, you can see in this sort of chart of the economies that are very dependent upon the U.S. for exports. And you're looking at a lot of Asian economies here, from Vietnam, Cambodia, Malaysia, many others. There's a few in here as well, like Ireland, part of the EU, and Canada is in there as well. Those two were actually, excluded from some of the worst of the tariffs. Of course, Ireland's part of the EU, hit with 20%, and Canada actually was not hit by these quote-unquote reciprocal tariffs because part of a different setup here as we look at the USMCA. They're facing a much lower tariff threshold, but a lot of those big exporters to the U.S., their economy is also very vulnerable to recession, as is the U.S. economy here, of course, in response to what we're seeing. So diving into the implications here, or some of the extensions from this, we might see more tariffs this week, actually. We'd love to see a deal this week, but we might actually get more tariffs on a sector basis. The April 2nd release from the White House excluded pharmaceuticals and semiconductors from the tariffs. They were specifically excluded from these country-level tariffs, suggesting there might be additional announcements maybe before those go into effect this week. Those pharmaceutical tariffs may be similar to the 20% on the EU and 31% on Switzerland, where we get a lot of branded pharmaceuticals from, and the 26% from India, where the U.S. sources generic drugs. The chip tariffs could be about the same as Taiwan's tariff rate, 32%, where the dominant chip maker TSMC is based. So while those sectors appear to have been spared, and I think pharmaceuticals actually did relatively well on Thursday, maybe on Friday as well, on the idea that, hey, maybe they're not going to be hit by tariffs, I think they're coming. And the potential tariffs for these sectors seem about as bad as what's been announced at the country level. Now, on the evening of April 2nd, President Trump said he was open to tariff negotiations if other countries offer something phenomenal. So what's phenomenal to Trump? I mean, what would get a deal done? Well, he seems to have a very flexible definition of what phenomenal is. He called the updated trade agreement with Japan back in 2019 phenomenal and tremendous at that time. It was kind of a minor update to that trade agreement, but he thought it was great. He raved about how great the update to NAFTA was. He retitled it as the USMCA agreement, thought it was fantastic, a great deal, a colossal victory, he called it. He also called that phase one trade deal with China, remember, the one that never really followed followed up with actually any real buying from China. He called that momentous and historic and transformative. So, he tends to really like these deals that he's made. And we've heard responses from many countries offering some willingness to make deals. Among the first nations to respond were those in Asia that we showed you on that earlier chart, this chart, that are really hit hardest by these new tariffs. In fact, President Trump posted on social media after a phone call he had with Vietnam's leader that the country is willing to eliminate all tariffs on U.S. goods to avoid new U.S. tariffs on Vietnamese goods coming into the U.S. And in a statement about that, Vietnam's government said the two leaders will discuss an agreement to formalize those commitments. And the country's even sending a delegation to the U.S. this week to finalize a deal to purchase Boeing planes. Maybe they'll have the opportunity to make their case. Australia's prime minister said his country would seek negotiations with the U.S. and would not impose reciprocal tariffs. So that's a little bit of an open door there to say, let's have some negotiations. Taiwan officials reportedly have been considering an increase in U.S. energy imports and tariff reductions, according to some news reports. And Malaysia's prime minister is trying to lead a regional response to the U.S. tariffs. We know Asia was hit hardest here. And India's government, rounding out Asia, stated that discussions were ongoing for the conclusion of a sort of beneficial bilateral trade agreement. The U.S. and India have been having some discussions. The U.K. and India have been having discussions. India's in a lot of free trade discussions right now. Historically, India has had very high tariffs, mainly protecting their agricultural products. They've talked about lowering those. They've, in fact, already removed all U.S. Tariffs on U.S. goods, on autos, on motorcycles, and bourbon earlier this year. So they've certainly laid out an olive branch as well. But in contrast to all of that, China responded to U.S. tariffs with an additional 34% tariff on all U.S. goods. So snapping right back with a big tariff on U.S. products. That's the most sweeping tariffs they've ever imposed. And that aggressive response might make a near-term deal to end the trade war between the U.S. and China less likely. Instead, China is seeking to boost consumer spending domestically. It makes up about 40 to 50% of GDP. Rather than spending their efforts on a costly deal with the U.S. to try and spare the less than 3% of China's GDP tied to direct U.S. exports. China has announced a big stimulus program planned to drive total deficit spending this year to 11% of GDP. They unveiled that back on March 5th. Additionally, China's government is likely to use its new tariff revenue to support exporters and to further offset the impact of tariffs on GDP. So those China tariffs come into effect on Thursday, one day after the new U.S. tariffs go into effect, maybe leaving a little window for negotiation, essentially putting the ball in Washington's court. But I would say it's fairly unlikely we'll see a deal before those tariffs go into effect. But in general, countries outside of Asia have communicated that they are preparing responses likely to be presented soon. For example, Israel has removed all remaining tariffs on U.S. imports and is seeking to negotiate a reduction in tariffs on their exports to the U.S. And as I mentioned, the EU is planning on, they're working on some negotiations today in terms of what that looks like, what they're going to present. But they're also likely to move forward on April 12th with their already announced retaliation against Trump's earlier steel and aluminum tariffs. So that's kind of where we stand on sort of deal making right now. Well, we'll have to see what comes up this week. Obviously, the market is keying off of any signs that a deal could be imminent anywhere. And that's the path to resolving all of this with the huge move we saw in stocks this morning. So how do we invest in this kind of an environment? Well, there are no winners in a trade war, but there might be some relative winners in the global stock market for investors to consider, including more domestically focused companies, European stocks, travel and leisure stocks outside the US, and stocks in Mexico, Canada, and Latin America. Let me go through this. So domestically focused companies, what do I mean by that? Companies that have more sales concentrated within their own borders. Sounds obvious in a trade war world. If you're trying to sell outside your country, you could be hit with tariffs. You could maybe have to impose reciprocal tariffs. If you've got a business that's really focused on domestic sales, you're probably going to fare a little bit better. And that has been the case both in the US and Europe. Specifically, companies in Europe are performing much better those that have a lot of domestic sales than those that have a lot of international sales subject to those tariffs. Global consumer discretionary stocks like autos and footwear have been two of the worst performing industries this year. They're very global, they have a lot of international sales, and they might continue to lag while more locally focused companies in, let's say, the utilities sector, the communication services sectors, they continue to perform better. The chart here shows this basket of European companies with high sales exposure to continental Europe has been on the rise, while those with more international sales, mainly US sales, have fallen. So this is the net between the two, showing that basically European stocks that have more European sales are soaring compared to those that have more international sales. So again, avoiding tariffs, winning strategy here, the more domestically focused the company. You can screen for this and take a look at what share of a company's sales are domestic. Some companies provide a lot of detail on this, some are a bit more vague on this, but there are baskets of stocks out there you can look at to try and track this kind of stuff. But they're certainly showing some strong outperformance even through Friday. This chart's through Friday. All right, where else? Just European stocks overall, actually. For Europe, the economic exposure to US exports is actually pretty small. And they've got this fiscal and monetary stimulus this year that can help offset the impact of US tariffs. So EU goods exports, European exports to the US account for only 3.5% of EU GDP. So a 20% tariff on the EU would probably result in a near-term direct hit to the EU economy of about 0.6% of GDP. That's not great. GDP in the Eurozone has not been great for the last couple of years, so that's not a good hit. But this year, things are really looking to accelerate. Forecasts are for much better GDP this year. And the offset to that estimated negative impact from tariffs is that Germany's largest economy, Germany, has already approved a big defense spending and public investment package. And the increased defense spending is above 1% of GDP, so more than offsetting the tariff hit, possibly. And the infrastructure fund of 500 billion euros is expected to lead to an increase in fiscal spending for the next several years that could add another 1.5% to GDP growth per year. So those two programs potentially add 2.5% to German GDP, way more offsetting possibly than the drag from tariffs. And additionally, across the European Union, the European Council, which is like the presidency of Europe, unveiled a proposal, just a proposal so far, but to exempt defense spending from EU fiscal rules and set up a $150 billion loan facility to fund military expenditures. And so all of that can really help to boost European growth. And finally, you've got at least three more rate cuts by the European Central Bank, which could take the policy rate below 2% this year. So all that additional fiscal and monetary stimulus might deliver a sizable boost to growth, potentially more than offsetting that roughly 0.5% drag from tariffs. Also, the EU was hit with 20% tariffs. That's less than their Asian exporters in Japan and South Korea, which compete for US export share with Europe in categories like autos and electronics. So they're slightly advantaged rather than, if you're buying a car from Europe as opposed to Japan, well, the tariff's a little bit lower, so that might benefit their pricing. And so that might even help them pick up market share of what's left of international market share in the US after these tariffs are implemented. So look, Europe's outperformance this year against the S&P 500, even after the sharp-driven tariff sell-off, really reflects the outperformance of about 20 percentage points this year. You can see this is through Friday, but we're actually picking up a little bit more today. Obviously, Europe's down today, but the US is down a little bit more. So this 20% gap between what's going on in Europe and going on in the US is pretty relevant. What you can see here is European stocks through Friday, we're still up 6.6% this year, still gained this year versus the big declines in the US. So something to keep in mind here, Europe has generally been a place to kind of hide out here from some of the storm tied to tariffs. Not immune, but again, a relative winner perhaps. And within Europe, one of the areas you might want to consider travel and leisure spending, meaning the hotels, restaurants, and entertainment industry within the consumer discretionary sector. It's probably obvious why. Inbound international travel amounted to 3% of US GDP in 2023. We get 3% of GDP from travelers coming from overseas to the US. And Canada is the top source of international visitors to the US, and it appears that Canadians are already Heading elsewhere, Canadian residents took 13% fewer trips to the U.S. by air in February than they did a year ago, and land border crossings were down 23%. But even more importantly, looking forward at air travel bookings through this summer, Canada to U.S. routes were down by more than 70%. If we look at March bookings to the U.S. from Canada, you can see the numbers here. This is straight from the industry tracker OAG. They track all the flights booked around the world, but they track to the U.S. And you can see the huge drop off in travel to the U.S. from Canada, more than 70% across the board all the way through the summer. So where are they going? Well, the other top destinations for Canadian travelers historically have been in Europe. France, Spain, and Italy are the three other top destinations other than the US. And according to estimates by the Bank of Italy, the tourism sector directly generates more than 5% of GDP for Italy. So that can benefit European economies overall, but specifically might boost services businesses in the consumer discretionary sector. Hotels, restaurants, and leisure industry within Europe may be a clear beneficiary of this trend away from the US travel. Okay, what else? Mexico and Canada. So Mexico and Canada were omitted from those April 2nd tariffs. The reciprocal tariffs did not touch Mexico and Canada at all. Remember the big chart Trump was holding up? Mexico and Canada weren't on it because they're obviously already part of the USMCA discussions and those tariffs, which they're now 25% for goods that do not fall under the USMCA. And that's about 40% of the goods. There's another roughly 45% of goods that could qualify under MCA, that qualify under the current most favored trading partner agreement between the US and Canada and Mexico. They could shift under. So upwards of 85% of Canada and Mexico's exports may still come in tariff-free. That could be beneficial, particularly related to what's going on. So once those fentanyl and immigration-related tariffs are dropped, it literally said in that fact sheet from the White House that tariffs on Mexico and Canada would likely fall to 10 to 12%. Well, that will be among the lowest for developed nations. So stocks in Canada and Mexico have continued to outperform U.S. stocks even after the tariff announcement. Again, not absolute winners. Stocks were still down, but down a lot less than what we're seeing elsewhere and in the U.S. And this might apply to Latin America overall. So interestingly, thinking about Latin America, Mexico being more Central America, Latin America, think Brazil. Right? Latin America's biggest exports are to China, not to the US. And its stocks are therefore more tied to China's domestic growth than that of the US. In fact, since we go all the way back to the inception of the USMCI Emerging Market Latin America Index, started in 2004, 21 years ago, it's delivered a positive average monthly annualized return of 5% when China's PMI was above 50. That's the threshold between growth and recession. When the U.S. manufacturing PMI was below 50. So when the U.S. manufacturing was in recession, but China's was growing, Latin American stocks were up 5% on an annualized basis. But conversely, when China's manufacturing session was in recession, the PMI was below 50, and the U.S. PMI was above 50, Latin American stocks fell on average 10%. So they're very sensitive to China's growth, not really U.S. growth. Doesn't matter if China's in recession and the U.S. is growing. Latin American stocks fall. But when China's growing, as it is now, the PMI is above 50, and the US PMI is below 50, which it is right now, that's a favorable environment for Latin American equities. This year, China's PMI above 50, the US below 50, that's helped Latin American stocks rebound on optimism around China's recovery and all that additional domestic spending they're doing, despite concerns over US economic growth. For example, the stock market of Brazil, Latin America's biggest economy, is up 10% this year through Friday, as measured by the MSCI Brazil Index in US dollars. So March stimulus announcements from the Chinese government did help to lift sentiment, and Brazil stocks, they even posted gains on April 3rd, the day after the tariff announcement by the US, and fell less than 3% on Friday, April 4th, about half the decline in the S&P 500. So you can see here, just historically, when China's growing and the US is not in terms of manufacturing, Latin America does well. So the point here is it's really about China for Latin America, not the U.S. In terms of their exports, and China may be growing their imports of Brazil and Latin American exports over the coming year. So something to keep in mind. So those might be some places to kind of hide out from the worst of the downdraft here as long as this lasts. Again, the markets are keying off of any sign that Trump is willing to pause tariffs or begin negotiations over tariffs, which may happen any moment. But in the meantime, favoring those 5-6 areas I just talked about might be a way to hide out from the storm. All right, Heather, let's move to chat Q&A. I've left maybe 5 minutes or so here to take some questions.
Thank you so much, Jeff. What is your insight regarding countries looking to make deals with Trump's? Is it hopium or is it actually a real possibility?
Well, Trump's a deal maker, given his history, and so I think he's eager to make a deal. He said after the market closed on April 2nd, after all those tariffs came out, he said he's open to making a deal on tariffs. I mean, I'll take him at his word. He's open to making a deal. He said the deals had to be phenomenal, but he's made phenomenal deals in the past on trade, so I think he's willing to do that. He may want these tariffs to be in place for a little while before he does so. Remember, he made big changes on the tariffs on Canada and Mexico 48 hours after he implemented them. And he might want these tariffs to be implemented for 48 hours or so to really feel the effect of them to show that they have some teeth before he actually pauses them or alters them. So it might be a little bit of time before we get to that, but I don't know. Yeah, I think he's likely to make a deal. Will he make deal with every one of these countries? Is he going to make a broad deal? Is he going to look to work with trading blocs like the EU or the Association of South Asian Nations, which Malaysia is trying to pull together? I don't know, but it seems to me that deal making's in his blood. He's, it's the art of the deal. So I think he's interested in making a deal. We'll just have to see how that progresses.
Thanks so much, Jeff. And you briefly mentioned pharmaceuticals and semiconductors as possible targets for additional tariffs. Do we see any other opportunities in specific sectors, maybe like solar panels, where we'd really want to be able to produce American production and use tariffs to do that?
Yeah, I think there are some categories where the U.S. has quotas, where the U.S. is going to be enforcing those quotas, and it's in more strategic areas. The U.S. Post the pandemic has taken back a lot of personal protection equipment, and we may be making some of the precursors to a lot of pharmaceuticals in the U.S. Going forward to ensure that we have these supplies, knowing that global supply chains can be disrupted, knowing that there are global conflicts that could also possibly disrupt the flow of some of those critical components. So there's some things clearly related to the U.S.'s health and economic security going forward. Things like new technologies, solar technologies perhaps, but certainly green tech, semiconductors. A lot of those things in some ways are being reshored, or at least domestic supplies are being produced in greater abundance. And whether that is done economically, I don't know. TSMC produces pretty efficiently in Taiwan. Will their plants in the U.S. be as efficient, as profitable? I don't know how much effort will they, investment will they be putting in those versus others? Unlikely they'll be exporting those from the U.S. So we'll have to see. It seems like there are lots of regionalization and localization of supply chains taking place across some of those industries like semiconductors, pharmaceuticals, personal protection equipment, perhaps solar panels. Generally speaking, batteries, those types of industries, there may be some positives in. I've been talking for years about how that could be a real ramp up in the U.S. Really hasn't happened. It certainly didn't happen under the Biden administration, despite a lot of efforts towards green energy, green technologies, and climate change. We really didn't see much of a ramp up in production of those things. So we'll see whether that changes. But I'd say overall, that's a relatively small percentage of U.S. imports. And if tariffs and quotas were to remain on those, it wouldn't surprise me. It probably also wouldn't derail economic growth to the extent that these much higher and broader tariffs are.
Thank you so much, Jeff. One last question. There's been a lot of focus on the VIX, the volatility index, and its most recent spike after Trump's announcement. Is that a precursor to further economic damage, and how do you see that possibly playing out?
Okay, so what the VIX is, it's the volatility index on the S&P 500. So essentially, it's a measure of what sort of future volatility, what the market's pricing in terms of future volatility. So generally, you're looking out over the next month of expiration in S&P 500 contracts and saying, okay, how much volatility is being priced into this? Is it a good forecast of future volatility? No, not necessarily. It's more about hedging today. So it really is a reflection of how are investors looking at the risk of large moves one way or another in the stock market. Generally, usually looked at as a hedge, so generally looked at the risk of a big downside move in the stock market. So when the VIX spikes up, it says investors today are seeking protection against downside volatility over the course of the next month. It doesn't mean that downside volatility is necessarily going to materialize. It just means they're positioning, they're hedging for that. Hedging as a heightened risk. They're perceiving that as a higher risk, so they're willing to pay up for protection against that. So it's just sort of a barometer of how the markets are feeling about risk. And so when it spikes up, clearly it's a sign that markets are nervous. And so it's more of a current sign of market risk assessment rather than telling us anything about the future. Generally, big spikes in the volatility index are followed by declines in the volatility index, right? You get a big rise. Nobody knows where it peaks, but when it finally peaks, it tends to move down as investors get a little less worried about risk going forward. So generally, that's going to move consistent with the stock market, right? So when the stock market bottoms, the VIX is going to peak and vice versa. That's generally what we've seen in the past. Usually when we get to big levels, 50, 60, 70 on the VIX, they're usually indicative of a lot of fear in the market, sometimes coincident with the bottom, but it's not a perfect indicator of that. So I'd be hesitant in looking at a spike in the VIX and saying, oh, this must be it. It's all in there. Markets are completely panicked right now. This has to be the bottom. I wouldn't count on that. Plus, I think there's a lot of moving parts to this, right? There's not just one deal. Sure, if Trump were to delay these tariffs by 90 days, it would suggest that maybe they don't ever get implemented, and I could see the market rallying on that. And if he were to offer, let's say, a deal with Vietnam, well, that's a sign he's willing to make some deals. But there's 190 other countries out there that he'd have to cut deals with. So it could be a slow process of, multiple highs and lows in the market here. Certainly a period of volatility, if not further downside. So that's why I bring out today, how do you invest in a trade war as opposed to saying, what do you buy for the rebound? I think that's a relevant question, but maybe not the most relevant one for today. Well, thanks so much for your questions, everybody. Always make the show better. Thanks to Heather and our producers, Andrew and Gabe, and everyone for joining us. Tune in each week at 11 a.m. Eastern or catch the replay on YouTube. And be sure to click on the show, click like on the show, and share your comments on what you're watching in the markets this week, what you think is going to happen with tariffs, and we'll see you again next week.